Let me now bring on board Samir Arora, fund manager and founder of Helios Capital. Samir, characterize the big picture for us. It's looking slightly scary, isn't it? Even though the GAR stress is over, Indian markets are massively underperforming global markets.
Well, first of all, you're talking about currency, which has been a big drag when you compare Indian performance with other markets. In the last few days, although generally I've been critical about Indian government not doing enough in terms of supporting the currency, but at least, say, for example, in the last few days, you would see that it's more and more clearly to do with US dollar strength rather than Indian rupee weakness, in the sense that even if gold corrects 5-6% in a month, and similarly other currencies like in Brazil and South Africa, etc. So as of today, although in general the macro picture has not changed or improved anywhere from, say, 3 months ago, but from a stock market point of view, I am a little bit more sanguine these days over the last few days, thinking that in general the markets have underperformed quite significantly, and the government, although it hasn't done enough, it seems to be signaling that it may do a few things. GAR reversal was quite a sort of a strong thing from a government which has otherwise acted very stubborn in every other sphere. And maybe over the next month or so, maybe after the presidential elections are out, they do a price hike in oil and petrol and maybe in diesel and other things. And then one or two here or there things can be done which would signal some reform if that also can be done. But even an oil price hike and a little bit of an oil price reduction itself globally, these things make me feel for the moment that I don't want to be more bearish on the market.
Samir, you're making the point as to how currency is a bigger concern at this point in time. Now that the GAR pressures, or concerns rather, have eased off, why are we still seeing weakness in the currency for India?
Well, that's more to do with the overall current account deficit. Of course, we normally help plug it by capital account, and we sort of made our own mistakes in terms of first introducing GAR. So the GAR part having gone back, the original problem still remains, which is that we need to bring current account in control, current account deficit in control. And there are two main issues in that. One is gold and one is oil. Now, gold imports, we believe from the numbers that come out in the papers, that in the last few months have fallen off quite a bit. And even naturally, I think that gold imports will come down, at least in the short term. Because even though we may say that we are consumers of gold, or that we use gold for jewelry, etc., but there must be an X part of that, maybe 5%, 10%, 20% of that, which was basically triggered by the fact that gold prices kept going up, and so there was a hidden investment element, as in you would prepone a gold purchase because you think the gold prices are going up. Now today, in rupee terms, gold hasn't fallen a lot, but it has clearly plateaued, and in dollar terms, it's fallen quite a bit. So even though somebody may say that when gold prices fall, it will unleash even more demand, I think that the demand doesn't change as much related to price, but there's an investment element which may back off. Anyway, whatever be the reason, we know that gold imports have declined in the last few weeks and months. And oil, although is the other big issue, even there the prices seem to be at least on the way down rather than the way up. They're down some $10 in the last month or so. So it may not, the overall current account deficit may not worsen from here, and therefore I feel that the currency may not strengthen in any way, but because of the new announcements of the government, because of GAR, and because over time government will increase oil prices, that the currency may hang around here, and that would be a sufficient sort of incentive for investors, foreign investors, to sort of take advantage of that level. Today, the fear is that the level may be good, but it may go down even more in the short term. Over time, it can again go down. If over a year it goes down 3-4%, that's the sort of cost of doing business in India. But what nobody likes is a sharp fall immediately after somebody's invested. So once that sharp fall is arrested, it doesn't have to reverse for people to feel attracted to it.
Samir, let's talk individual sectors. You own some private banks as well, and they're the ones which have really been hammered in the last few sessions. How are you approaching the banking space now?
Well, that is your definition of hammering. We continue to own nearly all the private sector banks. HDFC Bank, IndusInd Bank, Yes Bank, ICICI Bank, Axis Bank, ING Vysya Bank. You bring a few more private sector banks, we may buy them also, because we think there is a generic big picture theme, which is to do with the fact that there is growth in financial sector and financial services, and within that, private versus public. We like private sector because we like our companies to think on their own and not be pressurized into anything. We don't want them to be told whether to do a deal with Air India or not. We don't want them to be told to bail out somebody. We don't want them to be told to buy government securities, to cut interest rates. Nothing we want them to be told. And therefore, philosophically, we like them. And anyway, they all deliver good results year in, year out, quarter in, quarter out. So they can fall 5-10%. That market also has fallen, and so as part of the fact that the overall markets are not strong.
But what about valuations, Samir? The stocks which you own, HDFC Bank, IndusInd Bank, they're trading at crazy price to book numbers, aren't they? HDFC Bank 4 times, IndusInd Bank 3.5 times.
You know, when you go to Taj Hotel, you can go only a few miles away from there, although I don't know where exactly, but I'm sure you'll find a hotel at 1,000 rupees per room instead of 10,000 rupees. But people go there because the valuation is justified by history. There's one example today where you have blown up the history, say for example for Infosys, where suddenly because in the last 2 years the company has not delivered, people believe that, they have lost it. In banks, it has not happened. They have been at these valuations forever. They grow at these valuations. 50 quarters of 30% earnings growth for HDFC Bank. And in this year itself, the stock is up more than the market. As long as it doesn't go out of line, it maintains its premium, we don't mind. If the premium expands even more, then you may trim a little bit or not buy, and you buy the next. But the thesis does not go away. And this thing about valuation, we look at it from a portfolio level, that our portfolio valuations are not so high, so we'll have some low PE things here and there. But it's not that every one stock I'm going to look at it and say that it's 4 price to book or 3.5, because who told you that we have to look at this year's price to book and not a price to book 2 years down? If somebody grows 30% per annum for 2 years and somebody grows 10% per annum for 2 years, who has announced and told this rule that the price to book has to be for 2012 and not for 2014 or 15 or 17? There is no rule. It is all based on a reinforcement. It is based on somebody delivering continuously and being rewarded and earning it. That's why I've never believed in narrowing of valuations, that because a new company comes in, if SR Oil has been valued, somebody recently valued it at Reliance Industries. Over time it can be, but first you spend 10 years doing what Reliance did, then you can get it. But some new people come in, new analysts come in and say on day one, this is my benchmark because you are in the same sector. So it doesn't happen like that. And why don't we accept that there is no comparison for HDFC Bank, so don't compare it to others.
So, Samir, the big question is, what will change the market mood? What will bail us out? Global liquidity, valuations, or something drastically will change in Delhi?
Well, changing drastically in Delhi is the least likely, because if they haven't changed till now and they can't see the writing on the wall, how will they suddenly do it? I think basically it happens with time, and valuations is sort of linked to time. And foreign flows, actually look at it differently. In the last, what has been our sort of frustration with the Indian government is that the Indian government has not taken some specific steps to, in a sense, pass through the prices of commodity or hikes or oil or fertilizers, correct? That's the sort of big picture. And the second could be that we have not allowed FDI in retail and insurance, etc., to sustain our 7 to 8 to 9% growth rate. And that's why I've been very critical. But looking at from a global investor, he has seen that in countries like France and Spain and Greece, where the countries are about to go bankrupt and where the unemployment in Spain and all is more than 23-25%, and where the need for that if you don't do something now, in the next month you will go bankrupt. Even there, the public of that place or the system or the government or the politicians have still not allowed reforms to happen. So in some sense, although we still continue to be negative about our government, in some sense, if you compare it on a global level, look at what in other countries is happening, and even there no reforms are possible. So in some sense, I say that India is better in the sense that although we need a few things from the government, for a large part of the economy, we don't need anything specific from anybody. It's sort of an autopilot because of sort of being extremely behind the world for 100 years, and therefore for many years it can grow even without active intervention or active policies of the government. Relative to other places, not all the other places, but some of the other places, where it's not enough to just have something on an autopilot. It needs multiple things to be done, and still nobody's willing to do it. So we have to tone down our criticism of the Indian government, or even if we don't tone it down, a foreign investor who has a choice in multiple countries and markets may feel that India, or at least some parts of the market, which don't need this government policy making every minute, that they're still fine, and therefore we continue to get those flows. See, my confidence comes from the fact, and I was not very bullish till about a month and a half ago, comes from the fact that even after GAR, foreign investors did not redeem from India. They did not pull out the large amounts that they had put in. See, I have absolutely no interest in a domestic Indian investor's view other than the mutual fund guys, as in the retail guys who watch your channel, because they don't buy anything. And I don't know whether now anybody even watches business channels. And they talk more, and they criticize FIIs, they criticize that why Vodafone should not be taxed. They are just clueless guys. They don't drive the market. They don't like stocks. They just like to write in chats after every news that, oh, India is a sovereign country, we should do this, we should do that, without knowing anything, without studying anything. The reality is that we need foreign money, but somehow the foreigner is also interested in India, and they need only a little bit. Sometimes we agree to them, sometimes we don't, and when we don't, we are the losers, not them.
Okay, Samir, so let's talk about your portfolio strategy, and you would have guessed my question. Are you looking at buying Infosys at these levels? You've given us a description that Infosys could be a deep contract.
I actually bought it very recently at current levels only. My logic is that you are getting market type multiple for market type earnings growth, but without giving any credit to the history of that company, and to suddenly think that it's a write-off case, it'll never get a big deal, it'll never get a 2% extra growth, and therefore it's become like the market. I don't think that things are as bad. I mean, they are bad relative to their own history, but to get market earnings growth for a market multiple, there's nothing wrong. And plus, we know that whatever be the thing, currency is depreciating, and in the risk is that it may depreciate more. The risk is that people like developed markets more than emerging markets, in which case it helps anybody who's exposed to developed markets. On the other hand, if the emerging markets start doing well and Indian currency strengthens and emerging markets do better than US, then who cares about Infosys? We'll be all right with the balance 97% of our portfolio, and therefore it would not matter. But it's a good hedge in an environment where it's been beaten down without respect for history. I like to respect history.
Samir, what about the defensives? Anything that you like from the pharma or the consumption names, or do you think they're too expensive?
We basically like only these 2-3 sectors, not pharma as much, but we like India-oriented themes, and India-oriented themes normally come up in consumer and financial. We don't buy, these commodity, and we don't buy PSU. So anyway, our universe is much more restricted than a normal fund manager's universe. So consumption and financials are always there. We also used to have previously a lot of infra, but that since about middle of last year, we have not had anything meaningful.
Samir, do you think Indian markets will continue to underperform irrespective of the global situation? Because if I look at the headline number which we got for FY12, the world was up and India was down by about 9%.
No, that means you must be looking at March to March, is it?
That's right, financially.
If I look at it year to, because that is, that is your year. That is nobody else's year in the world. The calendar year, India is up some 6-7%, which I don't know whether it's underperforming the world or not, because it went up a lot in January. So overall, on a calendar basis, we did very badly last year, and we may be performing in line this year. but fears about India are much more right now. That is to do with the fact that at the beginning of the year there were many promises and none of them have been met. First was that, not a promise but an expectation that Congress will win in UP and something will happen. Then it was that they haven't won, so they will do a good budget. Then I became more excited thinking that since the railway budget is good, the main budget would be even better, not realizing that the railway budget was accidentally good. And then after that, saying, okay, now we are waiting for the budget session to be over to introduce a few things like this oil price rationalization. Now we have pushed it further, saying, no, now the presidential election has to be over before we do these things. But in the meantime, the currency has depreciated or gone back to 54, which was, sort of up 8-9% in Jan, and we have lost all of that and a little bit more. And then we introduced our own issues about GAR, and then we solved them or at least postponed them. So all in all, we have wasted 6 months or 5 months of this year. But somehow, I don't know, part of it is a feel of what the foreign investor has done, part is what our own companies are doing, and part is a bit of still having hope, because if you're an Indian and you don't have hope, you might as well retire. That I don't feel as negative today as I was feeling last year, middle of last year, and even till Jan of this year before I thought good thing about the budget, which never happened.
Okay, there's some comment from Reserve Bank of India. Samir, I'm just going to interrupt for a minute, and I think this is about export earnings or forex earnings. This is about if you are earning money in dollars, you're only allowed to keep 50% outside, bring the 50% back. And I think this is a move clearly oriented towards protecting the rupee from the free fall. So this is another market intervention. Now, Reserve Bank of India, even though we have a fat forex reserve of about $300 billion, because we are still a net importer of oil and oil prices are high, Reserve Bank of India also has a little bit of less elbow room this time around, because they pretty much are done and dusted with whatever they could commit to the open market. Impact on the rupee? Negligible. That's the technical setup we are in. The outlook for Indian currency is so negative that even the Reserve Bank of India has intervened and they have enforced the rule that if you are an exporter, you can only retain 50% of your earnings outside. Ideally, this news should have helped the rupee sentiment, but that's not happening. Samir, so when are you going to your clients and when you're trying to raise money, what is the India pitch?
Rupee right now, according to what I can see on the screen here, is up 1%. It will help, sir. Because all these guys who are buying 4-year, 5-year hedges, they have to bring it in now. See, the thing is, the rupee, why don't we accept it? It's a controlled currency. So if the government wants to do it up to a point, it can do it. And in the end, it may make it an even more serious problem. But right now, it is up 1%. That is, it is strengthened by 1%. So it is affecting.
All I'm saying, Samir, is that 1% is minuscule. I mean, look at the fall. And such a move, only 1%, that's nothing.
No, we are talking about today. I thought you were saying that even after today's announcement, nothing has happened. After today's announcements of 1%. But may I just give you, I'm not a bull on India because unlike all you, I've been much more bearish on our government and on everything. But the point is, in the last few days, let's be fair, it has nothing to do with India. Because I look at gold. Gold is effectively a anti-dollar bet. In the last, say, 3-4 weeks, gold is gold has fallen by 5%. That doesn't mean gold has fallen. That means dollar is appreciated by 5%. Yesterday, gold fell 2.5%, and Indian rupee fell 1.2%. I did not consider yesterday's fall of the rupee as something to do with India, because nothing happened yesterday morning in India. So, there are so many factors that. But the point is that if we make it a one-way bet because we feel like doing it, and we say 54 is becoming 60, obviously there will be a lot of intervention by the government. Then the speculators or these exporters have to really believe that can they sort of fight it. Are we all George Soros versus the UK government? I don't think in India we are anywhere near any of these guys. So Indian guys, if they see a 2% rally, they will think now it's a 5% rally and everybody will cover. Therefore, it is always good in some sense to break a one-way direction which is triggered by pure speculation, just triggered by yesterday's fall or day before's fall because it happened for 2 days, therefore third day it will fall. So once in a while I like it when somebody comes and breaks it, whether it can be sustained or not is secondary. Otherwise you will make these things go completely out of control. So in some sense they're doing the right thing by trying to sort of break the fall. It may again go up after a few days if that is justified. But let it not happen just because of your momentum and all the guys who come on your channel saying this has reached MACD, this has become 200-day DMA. Please, world doesn't work on 200-day DMA beyond 10 days for those 10 speculators who have believed it and are big enough for a few days to think that that is not how stock market or even currency investing is supposed to be. That 200 DMA is broken, so it's some God's given right to pile onto it. It's good. I like the Reserve Bank of India.
Okay. Technicals versus fundamentals, that's a good old debate. Samir, I know I've extended my appointment with you. So my final question is, what is Samir Arora's big call, big bet and big stock he's betting on for FY13? Let's be specific here. I want to revisit this call after 1 year as Samir Arora's big call.
I will not. You can look at my previous big calls, which was like a month ago. You have to give that same call more time, but I am not going to keep pushing my stocks on you. Everybody knows what they are because I keep talking about them to you and to various guys. But I am not going to be the flag bearer because that is embarrassing.